Welcome back, everybody, to our YouTube channel, Money Strong. And I am Brett Fry with Forterra's Wealth Management. What we wanted to do today was present a couple tax strategies for you to use during low-income years. So in a previous video, we talked about a Roth conversion, how you can take advantage of potentially a drop in income during COVID-19. Roth conversion is one way to do so. A couple other ones we'll present right now in this video, taking capital gains and accelerating income. If you have other questions about the Roth conversion, simply drop me an email or certainly go back and watch that previous video. So taking capital gains, the eventual reality is that taxes will be owed on anything, whether it's income, whether it's selling investments in the future to fund some sort of goal. So taxes are just a reality of our lives. And so what can you do, to minimize those taxes? Potentially people save and invest for retirement, to buy another home, et cetera, for all their other goals. Eventually, as long as those investments are outside of a retirement account, whenever they're sold, taxes are owed on those gains. So what many people don't realize is that if you hold those investments for longer than a year, you actually get a preferential tax rate treatment on those gains. Whereas if you hold those investments for less than a year, it's typically taxed just like income from your job or income from other sources. But what people don't always realize is that the percentage rates for their long-term capital gains are highly dependent on their income level as well. So if someone's doing very well for themselves, making over $434,000 in taxable income here, they could find themselves in a 20% tax bracket. But due to COVID-19 and maybe their income's decreasing, they could fall into a 15% or even 0% long-term capital gains tax rate. So how can you take advantage of this? Let's run through a quick little case here. So we'll say Bill, he's a restaurant owner who was forced to close down during the pandemic. Let's say during 2019, he was making $450,000 in taxable income. So he was in the highest 20% federal capital gains tax bracket. Again, this doesn't include any sort of net investment income tax or any state income tax. It's just kind of a simplification of, the three, federal capital gains brackets. But let's say moving down, this year, moving on, because of the COVID-19 shutdowns, maybe his income has gone down to zero. So he's going to show on his tax return zero taxable income this year. So it kind of puts him going from a 20% capital gains bracket last year to 0% this year. Then let's say, Bill expects things to kind of normalize out in the future. So his taxable income is going to go back up. He's, for the foreseeable future, going to be in that 20% capital gains bracket. So let's say he needs $100,000. His restaurants were going well. Let's say he has plans to open one next year. And he's going to use his investments to fund that new restaurant. So let's say he bought $25,000 worth of stock 10 years ago. Let's say today it's worth $100,000. So he has $75,000 worth of gains. Let's look at what happens if he were to sell that stock today, realize those capital gains, versus doing that in the future, even though he doesn't need the money until next year, realizing those capital gains next year. Obviously, this year, kind of as we went over, he would be in the 0% capital gains tax bracket, so he wouldn't owe any capital gains taxes on that $75,000 in gains. So he could take his $100,000 out, put $100,000 in his pocket, keep it there till next year, till he opens that new restaurant. But if you were to sell his investments, let's say it's still worth $100,000 in 2021, he would owe 20% in capital gains, so he'd owe about $15,000. The difference between the two, just by selling your investments this year rather than next year, accelerating those capital gains in a year when you're in a lower capital gains bracket, could have saved Bill $15,000. So moving on to strategy number 3 here, accelerating your income. So what we mean by that is many people have deferred sources of income. Perhaps it's stock options, restricted stock, deferred compensation, perhaps another income stream that you've deferred into the future. Well, if you can pull that into today, then you could possibly be paying a lower rate in taxes. So let's go over Jane here. She works at a company, has some stock options. She does well. She's typically in a 35% tax bracket in normal years, but her income and bonuses have been cut this year. So her income tax bracket's projected to drop down to 22%. But she expects, going forward next year and year after, her income will normalize. She'll go back up to that 35% tax bracket. So let's say she exercised some stock options. She has $100,000 that she can recognize, whether it be this year in 2020, she could exercise those options and take in $100,000 worth of income, or she can do that in the future. So let's look at the tax difference of doing that. So taxes owed, if she did it this year, again, she's in the 22% tax bracket. She would owe $22,000 in taxes versus exercising the options next year and owing $35,000 in taxes, or 35% on that $100,000. So the difference between the two, just by exercising the options now versus later down the road, she can save $13,000 in taxes. So, not chump change. That's certainly, saving some money in taxes in the long run. If you have any questions on any of these strategies we've discussed in the previous 2 videos, definitely shoot me an email, give me a call, visit our website. Also, if you have any comments, questions, or concerns, don't hesitate to reach out. Follow us on Facebook, Twitter, LinkedIn, YouTube. Don't forget to subscribe to our YouTube channel, because we're going to have more content coming for you guys soon. So don't go too far. We'll see you next time.